Now that we have used the worksheet to summarize all the data in our ledger and have prepared in good form the income statement, the statement of retained earnings, and the balance sheet, the next step is to close the books. Why? Because at the end of the accounting period, we have to transfer all the temporary account balances that we have to the permanent stockholder equity account, retained earnings. Now keep in mind that the revenue accounts at the beginning of the accounting period were zero, and at the end of the period they showed $10,600 in revenue. So that represents all the revenue transactions in that accounting period. The same with the expenses. They were all zero at the beginning, and their ending balances at the end of the accounting period indicate the amount of transactions, or the summary of all the transactions of those expense accounts. The same with dividends. These are called temporary accounts. The only permanent accounts are the balance sheet accounts. That is the assets, liability, and shareholders' equity. So therefore, at the end of this accounting period, in order to begin the new accounting period properly, we have to bring these accounts back to zero. Now to do that, we actually set up a new account, a temporary account called Income Summary. And what we're going to do then is close the revenue accounts to the income summary, and then the expense accounts to the income summary. And then we will close the income summary to the retained earnings. And then lastly, close the dividends to retained earnings. How do we do that? Well, in our journal, we head up the closing entries, all dated at the end of the accounting period. Now notice we do something different here. Service revenue, if you think of revenue as a T account, has a credit balance of $600. What I'm doing here is I'm journalizing this. I'm debiting service revenue $10,600, which means once I post it to revenue, revenue will have a zero balance. And I am crediting a thing called, or an account called, Income Summary. And I credit that, so it's $10,006 in Income Summary. So that's step one. Step two is I close all these expense accounts, which means I bring them to zero balance. Of course, salaries expense, all these expense accounts have debit balances, $5,200 for salaries, if this was salaries. So by posting this credit, $5,200, I close this expense account. I do the same for each one of these. And I transfer that total debit to income summary, $7,740. Now the third step is to close income summary. Well, to close income summary, what I need is 2,860 to make this a zero balance. When I add that to 7,740, it will come to 10,600. So you see I close income summary by debiting income summary 2,860 and crediting retained earnings. So retained earnings goes up, and this is our profit. So our retained earnings goes up by the profit. The last thing is we have our good old friend dividends sitting there. It has a debit balance of 500. I make a journal entry. I credit it 500 to make that zero, and I debit retained earnings, bring it down by the amount of dividends. So when I'm finished, all I have left, I have no revenue accounts, I have no income summary accounts, I have no expense accounts, and I have no dividends. And my retained earnings have gone up 2,860 and down 500. So the net effect is retained earnings went up 2,360. And in that way I've transferred the net income to the retained earnings. The only thing that's left in my ledger then are the balance sheet accounts. So again, this is a visual of how the ledgers was changed. So the salary expense account would have been zeroed, supplies expense, rent, and so on, all transferred, 7,740 to income summary. The retained earnings would be transferred, the revenue would be transferred to income summary. Then income summary is closed to retained earnings, and then dividends are closed to income summary. So the purpose of the post-closing trial balance is to prove the equality of the permanent account balances as the company goes into the next accounting period. All temporary accounts will have zero balances. All we will have left in the ledger with balances will be the asset accounts, the liability accounts, and the shareholders' equity account with the new retained earning balance. And this completes our accounting cycle. Recall, we started off by analyzing business transactions. Then we looked at how we recorded them in chronological order in the general journal. Then we posted them to what was called the general ledger, to these ledger accounts. We prepared a trial balance, and that is a balance to see if all the transactions that I have recorded in debits and credits are equal. And I have journalized those transactions for which there were source documents. However, there have been other things that have been going on that would not initiate a journal entry. These were accruals and deferred items. These happened over time, and at the end of the accounting period, I must therefore make some entries to adjust that between the income statement and the balance sheet, and adjust between two accounting periods. Once I've done that, I post them to the ledger, and I then prepare an adjusted trial balance. Once that is done, and I know that everything is correct, I prepare the financial statements, and then I close out the books. And I could test that again by taking a post-closing trial balance. And I start the new accounting period with asset accounts with balances, liabilities, shareholders' equity, including retained earnings, but the revenue account and all expense accounts and the dividend account are zero. And any transactions that happen in the next accounting period will be posted to those revenue and expense accounts, and therefore their balances at the end of that accounting period will reflect only revenue and expense transactions that have taken place in that accounting period. And that's the accounting cycle. We continually repeat it. We analyze business transactions, journalize, post, adjust, and prepare financial statements.